our great panelists. So, first of all, Najwa Mouhaouri, Head of Climate Finance Regulation Department at Banque Al-Maghrib. Salma, Chemsi, Head of Agricultural Expertise and Sustainable Development Pole, Crédit Agricole du Maroc. Tiriongo, Director, Research and Policy at Kenya Bankers Association. And Suzan, Hamdy, Chief Sustainability and Sustainable Finance Officer at Banque Misr. Thank you so much for being here, first of all. So I would like to start with a first question for all of you, and you can tell us more about your experience in the matter. So I would like to hear from you how you approach portfolio analysis and materiality assessment, and what are the motivation behind, like motivation for conducting, support, or requiring this analysis, and if you can share a practical example of how your institution is conducting such assessment, and whether you have used some of the UNEP resources that we have available on this purpose. So I would like to turn to you first, Najwa.
Thank you, Costanza. Good afternoon, everyone. Thanks for having me. It is my absolute pleasure to be taking part of this panel with such esteemed panelists who have different perspectives on impact, materiality, also financial materiality assessments, and as it was already perfectly said by our Deputy Director earlier today, we've conducted a risk assessment exercise. This actually falls within our primary actions and into the roadmap of the Central Bank to improve climate and environmental risk management practices. So after convening this financial sector platform with the objective of committing to Paris Agreement and sustainability development goals, the Central Bank has started really calling banks to take concrete actions to align their portfolios, businesses, and strategies with those objectives. And as part of the regulations that we've been setting in order to harmonize practices, also in order to improve the understanding of climate-related risks exposures across banking portfolios, we've run our first risk assessment exercise. It was a financial materiality assessment with the support of the World Bank, and as per any traditional financial materiality assessment, it involved the key steps and components, which are first the identification, then the assessment, the disclosure of key results, and finally also moving into implementation of mitigation strategies. So as a first step, we've had to, in practical manner, to share the practical experience. The very first step was really to map and identify activities, projects, and assets with significant climate impacts within the banking sector portfolios in order to assess in a qualitative manner which are the key transmission channels in the Moroccan banking sector, but also the key and most relevant climate risks in the Moroccan context. So based on the output of this first identification step, we could run the assessment, which involved a three-phase approach, I would say. So the first step was really to assess the short-term direct impacts through a catastrophic modeling approach, since Morocco is highly exposed to road drought and flooding, and this is actually reflected in the title of the report of risk assessment, which is named Double Trouble. We have the floods in the part of the country and the droughts in the other. So we've run this macroeconomic modeling approach based on the catastrophic risk model that captured the short-term direct impacts that were in turn propagated to the wider economy and financial sector by trying to, it involves actually an analysis of individual behavioral responses to initial climate shocks, but also the collective action of these behavioral responses, also trying to capture the subsequent macro-financial feedback loops. And as for the tools, we based our analysis on the HFS reference scenarios, which is actually serving as a basis of many risk assessment exercises of central banks across the world that was tailored to the specific impacts in the Moroccan context, which is not really the case in many of the advanced countries. So it was actually relevant to develop a macroeconomic Morocco-specific model, but also to adjust the international scenarios to the local context, climate priorities, and vulnerabilities. So we also, based on the AGF scenario that was tailored, we ran this scenario quantification and design process in order to assess portfolio level exposures across different IPCC ways to reflect both the Moderator and most extreme climate scenarios and their potential future impacts on the credit profile, but also safety and soundness of Moroccan banks. So the key findings were then disclosed to the public, but also the individual results were circulated to the Moroccan banks as part of our supervisory practices, the supervisory dialogue we're having, but also the supervisory review and evaluation that we're running, which is also embedding the climate and environmental considerations more widely. So this financial materiality estimate was actually critical to improve the understanding, which is this exercise, which is the first of its kind in the MENA region, was run in an explanatory manner. It was really as a first step for the central bank and the banking sector in Morocco to acquire more knowledge, to help build the capacities on materiality assessment within the banking sector that we currently supervise, but also to gather a strategic outlook about the portfolio alignment of Moroccan banks, because the key results, while they inform about the key exposures of banking portfolios, they could also indirectly guide Moroccan banks into directing capital towards activities and projects that are mitigating climate impacts while avoiding those that may have some significant harm on the environment and society. I don't know if I still have any time to touch upon the challenges, but I can keep this also for the second round of questions.
That's great. Thank you so much, Najwa. And as you're saying, it's very important, this dimension of contextualizing the analysis, right? So we heard this morning about the importance of understanding country needs, the local context when conducting such assessment. So it's great to hear that it's also something that is core to your process as well. Now I would like to turn to you, Suzan, on the same question.
Good afternoon. Thank you very much, Costanza, for inviting me and for giving me an opportunity to join this important discussion and gain insights, as Najwa said, from different perspectives. Well, let's imagine that banks now are like ships that are sailing turbulent and unpredictable waters, and they are now facing financial storms which are shaped by climate change and regulatory changes, underwriting, and the rising societal expectations. So with the new CSRD and the coming regulations and the CDE in Egypt also binding regulations, the regulators don't expect you or don't require only to report on your sustainability impacts, but really deeply understand how to manage them across your portfolios. And therefore, the traditional ways of financial matrix only of going through a portfolio health check is not enough. We cannot rely on this in these very challenging times. Therefore, we need more than just a health check of the pulse and blood pressure. We need a strong, sophisticated diagnostic sonar or MRI, and this is the materiality assessment, which like the tools of the UNEP, and these tools really. So if we say that the portfolio assessment is the health check, the materiality assessment is our compass. It shows us how what is important for us, how we focus our priorities. Apply at Congress the double materiality concept. We report on the GRI and the UNEP. We use the UNEP to conduct our assessment based on this based on the impact radar requirements, but also comes from internal conviction that we have to detect emerging threats while identifying opportunities to position ourselves for the green water region. We have in Banque Misr, probably some do not know that Banque Misr is the second largest public or state-owned bank in Egypt, and of course is one of the arms of Central Bank of Egypt for sustainable development and for its policies. We have issued, Banque Misr issued 2 PRB reports, and we are now issuing our 3rd one, and this shows a clear shift when you read the reports. It shows a clear shift in that sustainability in our perception and our transformation journey. That sustainability is no longer a side issue, but we're trying to embed it in our core DNA, and it is not a side project anymore. Using the tool has really enabled us primarily in 3 things. First, to map our exposures against Egypt's Vision 2030 and its development needs, whether it is climate resilience or clean water or renewable energy. The other is to identify the sectors that we have significant impact, whether this is positive impact or negative impact, and then we prioritized our lending and our sustainability initiatives to align with this, with Egypt Vision 2030 and our stakeholders' needs. Materiality is not for us, it's not just a thing, check the boxes, but rather a prioritization framework. So moving to the practical side of this, we mapped the environmental and social impacts in our construction portfolio. Circularity was one of the impact areas that we wanted to tackle, and we identified how we can reduce the resource consumption and waste. We engaged with 50% of our corporate clients, and to show them how we can help them, how we can support them. Also, we needed to assess where they are on their sustainability maturity level so that we can be able to help them, and this really has helped them and helped us first in our strategy to align these sectors and how we're going to position our lending in the future to these sectors, especially the real estate and building materials are also one or 2 other sectors that are very correlated to construction and are high in our portfolio, are high percentages in our portfolio. Engaging with clients was really it showed us that we are a partner to them. We are not just a lender. This also increased our client loyalty because they saw us no longer as a lender, but as a partner and strategic advisor to them, which is an important role also for us as Banque Misr to support Egypt's sustainable development. Moving from climate finance, moving beyond climate finance to financial inclusion, which is one of the pillars of sustainability and our sustainability strategy. We used also the frameworks, and on a quantitative level, we measured the number of account openings, digital inclusion, disbursements, loans. We began to disaggregate our MISs so that we can know according to gender and age, so we know how much loans have been dispersed to women. I have some statistics, and this helped us in 2024 to issue more than 20,000 micro loans, opening 870,000 accounts, including 160,000 mobile wallets. We distributed close to 900,000 prepaid cards. So these tools help us bring the impact into the formal economy and track our reach. So it's not only on the quantitative side, but also on the qualitative side. and we engage in financial literacy, more focused financial literacy for women and for youth. We have engaged in 5,000 financial literacy in 2024 for 700,000 Egyptians. As I said, we segment our portfolio by gender and age, and this helps us in aligning with our sustainability initiatives for financial inclusion. We have on the gender empowerment that helped us to partner with IFC. We have the ZAT program. This is an SME program for women only. And this also helped us increase and put a target to women. Generally, we didn't put a target to MSMEs relating to women. Today, we have 25% of our portfolio of the SMEs of the 130 clients are to women. For us, as we said, materiality assessment helps us navigate these challenging times. It's our GPS. It is a prioritization framework. At Banque, Misr, we don't see it only as compliance with the regulator. We want to be at the forefront, not just reacting to or responding to change. We see that this is our role to help Egypt's green transition and financial inclusion goals. Thank you.
Thank you so much, Suzan. And as you say, it's very important to highlight this point that materiality assessment is not just about identifying topics for disclosure, but it's very important that the results, the outcome of this assessment is used to understand what needs to be managed by the institution. And as you're saying, since there is growing expectation on the regulatory front, but many banks at the moment are conducting such assessment from, for example, a voluntary to respond to voluntary requirements. It's very important that they can leverage the existing processes and analysis to be able to also respond and not duplicate the exercise. This is also why, for example, at UNEP, we have created this interoperability package of resources to enable PRB banks to use the impact analysis resources and the exercise that they are doing to respond, for example, to the CSRD requirements on impact analysis, on materiality assessment. So it's very important to leverage what banks are already doing in order to avoid duplication, of course, of exercise. Now I would like to turn to you, Salma. Can you also share your experience around this topic, the motivation behind, and some of the resources that you have started to use?
Thank you, Costanza. Good afternoon, everybody. Okay, in Crédit Agricole du Maroc, Crédit Agricole du Maroc is the agriculture bank in Morocco. So we've been interested for more than 60 years, and we've been interested in social and environmental issues for several years ago. And we believe that sustainability is not an option, but it's a necessity and a must. That's why we've been working in sustainable projects. We've conducted and realized several projects with our partners, international and national partners, in order to realize the objective of sustainable development, international sustainable development objectives. So, as we are committed to the international sustainable development objectives, and as we are committed to the implementation and the implementation of our internal laws relative to the environmental issues and to the national strategy of sustainable development, we are interested in portfolio analysis and
of UNEP resources from your side and from Suzan's side, so that's good to hear. Now I would like to turn to you, Samuel, your perspective on this as well. Can you share also your views on the motivation behind conducting these materiality assessments, and whether you can share also some example of banks in Kenya, for example, what resources they use, what kind of approaches they're following. Over to you.
Thank you. First, I must say thank you for inviting us to be part of this panel today. And we look at, of course, at the risk of repeating what has been said, but I think the standard approaches that have been used in portfolio analysis and materiality assessment is basically just to emphasize one aspect about the initial conditions, pre-existing conditions within the market, as and when reporting requirements come into being. For Kenya, I think we must appreciate the fact that the Kenyan journey on sustainable financing and banks championing for sustainable finance started way back, almost 10 years now. And it was not until 2021 that the regulator, the Central Bank of Kenya, started to kind of similarly ask for reporting to be done. And so it was basically voluntary disclosures. The banks had to make disclosures around this. And over that time, there was a lot of capacity building, championing the banking sector to be able to embrace sustainable finance. And that helped quite a bit, particularly when the time came for reporting. For banks to make disclosures, it made it much easier. And therefore, we look at transition generally from voluntary disclosures towards mandatory disclosures, and therefore the need for banks to do portfolio analysis and materiality assessment became much easier because banks really had internal capacities to be able to do the same. Of course, I must say that there is always room for improvement in terms of the approaches that can be done or taken for purposes of ensuring there is deeper portfolio analysis, more accurate analysis, so that at the end of the day, banks are able to display their portfolios in a much more accurate way. So if you look at the emergence of regulations and requirements by the industry to report, actually entrenched the need for banks to be able to do much more portfolio analysis in a more accurate way. So banks in Kenya look at determine the areas where they have significant impacts and are able to report on the same. And the Central Bank gave a guidance in 2021 for banks to do climate risk disclosures. And because already of the initial conditions that have been established, the market went on to look at standardization of reporting. So we were able to champion as an industry association, and I think at this point allowing them to emphasize the role of industry associations, particularly in championing banks to make progress, particularly on sustainable finance. And we were able to come together as an industry and create a template for reporting, TCFD-based template. And the Central Bank received it as a tool for them to even standardize the reporting, because they're just given guidance to the banks to do reporting in the format that they deemed fit. So for us, we appreciated the need for us to come together and do a standardized reporting, which the regulator also embraced. And I must commend the fact that there is working relations between banks, the banking industry umbrella body, the Kenya Bank Association, and the Central Bank. So when this Central Bank published now a climate risk disclosure guideline, and even last month it actually published the taxonomy, as was mentioned earlier in the morning, and the climate risk disclosure framework for banks. Again, we quickly were able to come together, particularly in collaboration with other entities like the Institute of Certified Public Accountants of Kenya, to develop a standard template, again based on IFRS S1 and S2, which is really talking about sustainability related disclosure. disclosures as well as also climate-related disclosures. So the coming together of industry is really made possible by the industry having embraced the need for us to make disclosures. And of course, the need for disclosures have already been felt in the market because so far banks appreciate that it's important to do deeper portfolio analysis, deeper materiality assessment, and of course the disclosures that come with it. Because from the data, they are able to, first of all, of course, paint a true picture of where they are in terms of the transition, and also, of course, generate insights that will actually be able to support their strategic planning at the end of the day. And much more, so again, to paint a picture to stakeholders of what exactly is happening. So banks being able to appreciate the transition, particularly to sustainable banking practices, and even going forward to champion for standardized reporting in the industry for comparability is becoming increasingly important, and banks have appreciated that. Of course, there is always room for collaborations, room for exploring opportunities to ease the processes of portfolio analysis, and we welcome initiatives such as the ones with UNEP, the GRI, particularly for listed financial institutions in Nairobi, and there's a lot of concurrence, particularly for financial institutions, but we must appreciate there's always room for improvement, room for collaborations with various institutions, and must start at this point with UNEP for the principles of responsible banking, that banks in one way or another find it useful, particularly in deployment within the banking sector. So as we look at the emergence of global standards, the need to domesticate the standards to a particular setting is also increasingly becoming important. But much more important also is the need for collaborations with institutions of like minds within the country for purposes of ensuring that there is a quicker transition, there is a quicker embrace, and a quicker capacity building well enhanced within the country for institutions to transition. So I want to keep it at that, but one thing also to emphasize is the fact that as we do unified templates, as we do consolidated templates for reporting within the industry, it's good to anchor it within global best practice, but also the realities within the country of what is important, what needs to be given priority, and what needs to be taken on board, particularly for, and the demonstration generally of the importance of the initiatives that are coming on board. And that works very well for institutions to embrace. Other than for them to feel like it's a regulatory compliance issue, the need for them to embrace it from a standard working practice or being able to demonstrate to stakeholders the importance of the transition, which works for them at the end of the day. The brand value is enhanced if you look at it from that standpoint. Thank you.
Thank you so much, Salma. And yeah, I really would like to stress this point that you made in terms of making sure that we come together, we align, standardize. Those are very important words, and I agree with you that it's very important to make sure that the outcome of the exercise is robust. So I would like now to do our second round of questions, now a bit more tailored to each of you, to share a little bit more your experience. So starting with you, Najwa, again, from a supervisory and regulatory standpoint, if you can tell us how and to what extent have requirements around portfolio analysis and materiality assessment evolved, and how they're continuing to evolve over time, especially in this context of emerging regulations such as the CSRD, and what role central bank play in encouraging and shaping these developments? Thank you.
Yes, thank you for this question. And one takeaway I can give from the experience that was shared so far is that while the components of these impacts and materiality assessment are quite similar, the tools and methodologies may vary across financial institutions. And I think that in building sustainable markets and economies, central banks have a key role to play by implementing the necessary enabling environment and incentive-based financial sector reforms, but also in shaping sure alignment with the international standards, to make sure that Moroccan banks are moving into the same direction, because following up on the system-wide roadmap for sustainable finance, Moroccan banks were taking several measures and actions towards mobilizing the capacity for climate action and sustainability, while the approaches were quite different. So we have the goal to be also harmonizing practices through regulation, and the key references that we are referring to in our regulations are the international standard setting bodies, which are the Basel Committee for Banking Supervision, but also the IFRS recently issued standards for sustainability and climate disclosures. So as per our first regulation for climate and environmental related risk management, we are calling banks to put in place the necessary analytical tools, including portfolio level assessment, in accordance with the Basel Committee's effective principles for managing climate-related risks, which urges banks to use scenario analysis and stress testing for assessing financial materiality across portfolios. We have recently came up with a new regulation on climate disclosure to improve transparency, market integrity, and consistency of the data that we could be collecting in the central bank, also the data that will be available for financial markets and investors. So we are calling our banks to be compliant with the ISSB. We think that this framework is broad and flexible enough to accommodate some of our unique challenges when it comes to adaptation and physical risk, given our greater exposure to physical risks, while the ISSB is being focused on some mitigation metrics, especially reporting on emissions scope 1, scope 2, and scope 3 that may be very challenging in terms of the data needed for banks to be reporting on this scope. We think that this is also a good opportunity for us to maybe implement some specific criteria on adaptation. So as we move forward, we should be supporting banks in implementing those sustainability and climate-related disclosures through more practical regulatory guidance, through supervisory oversight, also national coordination. And I pick up the points of Samuel on the need and the importance of national coordination when it comes to setting up harmonized practices and frameworks. And we've seen the value and the benefits of having these common principle-based framework, the roadmap on 2016, that it paved the way for many measures that were trying to regulations to be harmonized and to avoid fragmented disclosure frameworks. So we're closely coordinating also with financial regulators of capital markets and insurance companies to make sure that our regulations are convergent, while also trying to be, to the extent possible, as much as possible, to be aligned with international practices. We know that materiality assessment have evolved from purely financial focus to double materiality, which also considers the impact that financial institutions may have on the environment and the society. But we consider it very early for us to consider, to fully account for double materiality, because this would imply and require some huge investment on data infrastructure for Moroccan banks, but especially high cost for smaller banks and institutions, which are serving SMEs, and given the economic ecosystem in Morocco, and corporate ecosystem, which is dominantly, which is primarily serving SMEs that are accounting for 80% of the Moroccan corporate ecosystem, it would be really quite challenging. But through coordination with the national stakeholders, and as part of the recently strategy for developing climate finance, by 2030 we should be able and moving towards more granular standardized disclosure frameworks, while ensuring the coordination with the national stakeholders for having the necessary data sets and necessary data outputs, while trying also to overcome some of the key challenges to be in a better position to maybe also account for double materiality. While the ISSB focus on financial maturity may limit the comprehensive climate or sustainability reporting, we think it's a necessary precondition to really more banks on the climate and sustainability disclosure, put in place the necessary data infrastructure and data sets, to make sure that the national stakeholders and policymakers are also working on improving the availability of data, on reducing the investment cost of handling the data, especially for small institutions and corporates, and then really consider the materiality, because while the CCRD is not really, Morocco is not really subject to CCRD, our treaty is tied to the European continent and to the European carbon adjustment mechanism and the European frontier. For the sake of time, I'll stop being able to make sure we don't speak.
Thank you so much, Najwa, and thank you so much for sharing your reflection on this evolution of regulatory expectation, but also the challenges that are specific to the Moroccan context. So thank you so much. Now I would like to turn to Suzan and Salma to ask you if you can share with us some of the benefits and challenges that you face by conducting such assessments.
We believe that banks that go beyond compliance and will lead the coming decade. So those banks who engage in or embed sustainability in every facet of their operations definitely will lead. And therefore, it's for us the benefits of these frameworks and using UNEP tools enables us to be at the forefront, not just compliance. There are a lot of strategic, operational, and compliance benefits in using the UNEP tools. For starters, it allows us to identify risks, and we have enhanced identification and risk management, and not only just identifying the risk, but how to proactively manage them across different sectors and portfolios. The second thing is that the methodology it's built on a holistic and modular methodology which covers all ESG or full ESG issues, and at the same time it shows you how you're exposed to climate and other social dynamics, which really is flexible and relevant. The other thing, it allows you to track progress for us over time. Also the data-driven output from the tools allows us to engage with our sustainability governance bodies in the bank, with the board engagement, because with the heat maps and the summary tables, it is much more, it facilitates our critical review of these issues, and it helps them with better decision-making, understanding, and better decision-making. Also, these data-driven tools or data-driven output tools helps us with our strategic priorities, because it gives us and it gives the regulator and our stakeholders much more improved confidence that all our strategic priority, or that when we decide on aligning our strategy with the highest or significant impact areas, we're doing this based on analysis, deep analysis, and targeted, and our targets are based on data that is transparent. I believe also that there are a lot of other benefits. Really, it aligns also. It supports banks to align with their countries which they operate in, and not necessarily only. And for us, we operate in the UAE and other countries, and therefore, when we use the UNEP tools across the countries we operate in, it will help us to manage these across the countries and societies we operate in. It also gives us insight, as we said, in the construction sector, engaging with our clients, and depending on the insights we got, it makes us more able to have more product innovation and tailor our financial terms. There are a lot of other benefits really, but I don't want to take much time, but this journey is not without challenges. There are a lot of challenges, and the main challenge is the data quality and data availability, especially at the client level. Because ESG disclosures are still evolving in Egypt. The second challenge is the internal alignment and the internal integration across all functions, because you have to change the process. There's a process redesign, policies have to be changed, and alignment and the buy-in. The third challenge is the client engagement, or let's not say only client engagement, it's translating these insights that we have out of the UNEP tools and the materiality assessment into actions. And one of the most important actions is client engagement and product innovation. And this needs a lot of time, effort, resource, and investment. However, at Banque Misr, we don't see this as a burden, we see it as an opportunity to detect emerging threats, to see not to explore new lands, but to see with new eyes, and therefore position Banque Misr to be, enable it to be a resilient, future-ready institution, to be able to maneuver or navigate in these challenging times, and to support, of course, Egypt, as I said, in its green transition and financial inclusion goals. Thank you.
Okay. So, as I said in the first part of this discussion, as we adopt this approach and as we are committed to international and national agreements and we comply with our national laws, of course we enhance our reputation. This is the first benefit, what is beneficial point for us. And as well, we do have a better understanding of our potential environmental and social risk, which means that when receiving our clients' projects, we can well study these projects and we can make a better decision, having potential risk, reducing the risk, mitigating them, and avoiding losses for both of us. Another benefit has to do with the relationship we do have with our clients, because when convincing our clients about sustainable projects, we need to have to take a long time for convincing them, to have discussion, negotiation, and this strengthen our relationship with them. So that's as a green bank, we encourage our clients to take loans for green loans, and we encourage them to have technical assistance for free of charge. And this technical assistance means that they become more confident in our loans, and they are socially responsible, they get revenues, and they protect their environments. So this is, this of course have another cost, which is a challenge, which means that we should have good communication skills with our clients, which means that especially that our bank is covering all social levels in our financing, so we need to have good communication skills. And also we do have to be up to date with all new technologies. So now when we receive projects from our customers and we need to have an expert study, we make a call for external experts. But as the demand will increase over time, we will need to have our own experts, which means that we will need to invest a lot in our capital, human capital, which means that the big challenge we have right now is the human capital. We should have highly qualified personnel, and at the same time we should invest a lot in training. So I think these challenges are the engine that push us to be creative and to find a better solution for sustainable environment.
Thank you so much. Thank you so much both for sharing your insight and experience on benefits and challenges. We have heard a lot of benefits, better decision making, better relationship with clients, and also a lot of challenges. But as you were saying, these are more seen as a way to push and just do more, basically. So, of course, data is a recurrent challenge, and also the fact of expertise. Expertise is also very important, and this is, of course, an element that needs, in many situations, needs to be improved because it's a real challenge. So I would like now to move to Salma for our last question. If you can, so before you were talking about the importance of harmonization, coming together. So can you just briefly tell us if there are any obstacles to that harmonization that is sought at the national level in terms of approaches for materiality assessments?
Yeah, thank you. I think in the interest of time, I'll keep it very brief in terms of definitely the call to harmonize approaches is important, because again, if we have multiplicity of reporting frameworks, disclosure frameworks, analytical frameworks that we have, it's a burden on financial institutions. And definitely at the end of the day, financial institutions would want, if it's possible, to spend the least time in making disclosures. Data capture should also be, the possibility of that being made more efficient is critical. You find that in Kenya, for instance, while the Nairobi Securities Exchange is exploring even the publication of responsible investment index for each institution that is listed, that works as an incentive, particularly for institutions to even invest more. The Capital Markets Authority is looking at the possibility of the deployment of technology in ESG data capture, again, to enhance transparency and of course, at the end of the day, when data is captured, then that enables even ESG reporting to be made more efficient. So the reporting standards and frameworks, I think it is important for them to be harmonized. No doubt that as they get harmonized, they reduce the burden of reporting for financial institutions and even encourage them the more to make much more disclosures and invest in that process. So the benefits, again, definitely is important to highlight them to institutions, the benefits of these disclosures, so that there is incentive, drive within the organization to conduct deeper analysis, deeper assessments, and of course invest more resources in it, and make sure that there is efficient allocation of capital in a way that they are able to demonstrate to potential stakeholders. When you look at the other benefits around the disclosures, and of course data capture and disclosure is really the issue of strategy development, the issue of being able to tap into emerging sources of capital. Like for instance, of course, blended finance, social bonds, green bonds. With data, they are able to quickly demonstrate that, and they are able to tap into those opportunities. Then we are realizing in Kenya that many stakeholders, particularly investors in the banking sector, are becoming more alert to ESG, which is good, because in itself, that drive for institutions to invest in it becomes even much, much more stronger. So the harmonization of reporting standards, I would say, is important for reducing the burden on reporting, particularly for financial institutions, and incentivize many of them to transition. Because again, if the burden is too high, then it becomes a problem, because institutions would look at it from, as somebody mentioned, at the end of the day, it has to be rewarding. And the financial reward should, of course, be tied to minimal costs of ensuring that the transition is not costly at the end of the day. So I'd want to keep it as short as that, but of course re-emphasize in all this, in the harmonization, collaboration is key. Working with like-minded institutions critical institutions that define the benchmarks, define the regulatory standards is very, very important. But of course, domestication of some of the global standards is also key, perhaps, because at the end of the day, the relevance of international standards has to be weighed upon the business case within each country. And the move by institutions towards the transition of deeper analysis, deeper disclosures, is really informed at the end of the day by the financial return. Thank you.
Thank you so much, Samuel, and thank you for all the panelists for being with us today. Just to conclude, I would like to say that some of the key remarks from this discussion, I would say that of course there are some challenges, but there is a real strategic benefits in conducting materiality assessment, both in terms of making sure that banks can align with sustainability priorities, but they can also respond to regulatory and voluntary expectation. Just briefly before concluding, I would like to show you some of the resources that UNEP has developed to conduct materiality assessment. What you can see here on the slides are resources for impact materiality assessment more specifically, but as we said before, impact materiality is often seen as an input to the financial materiality. So you can see the impact protocol, which is a guide that explains step by step how to conduct an impact materiality assessment. And then we have the impact analysis tools, which are ready-made tools publicly available on the website. Suzan was mentioning them before, that enable banks to input data regarding their portfolio and see a number of visualization and output regarding the significant impact areas. And finally, we have the impact radar and mappings. Salma mentioned the radar. Radar categorizes sustainability topics, and the mappings are used to make sure that banks that want to develop their own tools can also refer to those resources. So thank you again to all of you for having this very interesting discussion, and for the audience for attending. So thank you again.